Good evening, guys. It is Wednesday, February 5th, 2025. This Bathrobe business. I'm all out of decaf coffee, but I still have the news. Let's jump into it. Today's episode is probably going to be kind of short. I only found a handful of stories that I thought were interesting and had greater market ramifications. And so I'm going to kind of share them with you rapid fire, which is fine because the last few episodes I've had have been really long. I try to keep these down to about 10 minutes, but I think all week I've been doing about 20-minute episodes. So let's jump into the first story. The first one is going to be out from Disney. Disney had a fantastic quarter. So Disney teases new streaming service crackdown on password sharing and 40% year over year earnings growth. So Disney Plus did fantastic. Bob Iger has come back with a vengeance. I know when he was first back, they were saying that he can't catch lightning in a bottle again, but he's proven that he can. They had a fantastic quarter. They had $1 billion in streaming service profit for the year. That's amazing. That's amazing. Let's not forget that streaming is still very, very difficult to get right. Amazon still hasn't even cracked it. HBO Max is a mess. Paramount is a mess. But Disney came in late to this, but they have kind of mastered it. One of their growth strategies is live TV, specifically live sports. That seems to be the strategy both it and Netflix are taking, and is paying off fantastically. It seems like they're going to be launching a separate streaming service called ESPN Flagship. I'm still unclear whether or not this will be a separate subscription, but they are going to be raising their prices anyway. So this could be a moot point anyway because they're raising their prices. They might roll it all into one product, but it's going to be essentially a separate streaming service piggybacked off of Disney Plus. They saw growth of 6.8% due to strong quarter one performance. Both the Disney and Hulu subscriptions grew for the quarter in spite of price increases. Additional content-driven subscriber growth is anticipating, aligning with overall positive revenue projections. Let's not forget they had 3 fantastic movie offers just in the fourth quarter alone. They had Inside Out 2, Deadpool, Wolverine, and Moana. So fantastic quarter. You got to give Bob Iger his flowers because I think he's pulled off another stroke of genius of bringing Disney back where just a year or two ago we were saying that it's falling apart. I also think why this story is interesting is because we see that these streaming services really are becoming the new cable providers. We're seeing it with Netflix, and we're seeing it with Disney Plus as well, where they're trying to capture as much of the visual market as possible. They're bringing in live sports, they're bringing in movies, they're bringing in television. They're trying to become more and more of one-stop shops. And this is a growth that we've seen very well with Netflix, and Disney is just doing the same. Next story I want to talk about is going to be Ford. So this one is interesting for a number of reasons. So we've seen General Motors come out with fantastic earnings, but somewhat muted guidance for 2025. Tesla, we're not even going to talk about because Tesla's a dumpster fire, much like the Cybertruck. But Ford had a very strong quarter as well. So Ford had revenues of 39 cents per share versus 33 market estimate. Automotive revenues of 44.9 billion versus 43.2 billion. So fantastic quarter across the board. They are much like GM and like a lot of companies that have been showing their earnings for this last couple of weeks. More and more are calling for a muted 2025. A lot of it has to do with tariffs. But I also think a lot of it has to do with very fantastic quarters, and they don't think that they can meet those same expectations in the coming year. One of the interesting things here is also that they lost money, about $5 billion in EV sales. So despite the fact that they have a couple great EV flagships, both the Ford F-150 Lightning and the Mach-E, both fantastic vehicles, they are still losing money on electric. Electric is a very, very difficult market to crack. All of their growth came in spite of electric from traditional internal combustion engines. This is why I say like companies like Nissan and Honda have to merge, because you're almost having to merge or buy out your competition in order to acquire market share. There just is no other way to make this profitable. This is why Jaguar is trying to redefine itself. It's why so many automakers are struggling so much with EVs, is because when you're going EV, everything is more commoditized. So you have no room to compete on anything. So you kind of have to buy out the competition. And we're going to see more and more of these firms become consolidated or go out of business. So if Nissan doesn't do this, if they follow up the merger, which from the chatter seems like Nissan is doing, it's probably going to mean that in the next 10 years, Nissan might not exist as a company. If current rates of EV growth continue, I don't see Nissan surviving. Nissan needs this. So I still think the merger is going to happen regardless of what stories are coming out. Now, coming back to Ford, again, another automotive company that's calling for muted growth. We've seen that coming out of GM. We've seen that out of multiple companies, everyone from Google to Microsoft. Meta still hanging in there, but all of them are seeing a bit more muted and stifled growth. Along with, we saw freight shipments that we talked about from Prime Rail the other day are somewhat muted as well. They're seeing growth coming back to levels of what they were seeing pre-COVID. Essentially, up until this point, we were still clearing COVID backlogs. So I think 2025 is going to be much more muted than everybody was anticipating, myself included. I thought that with Trump in office, we're going to see lots of rallies in the business sector, but these tariffs are definitely weighing down the market. We'll have to see what happens after first and second quarter, after Trump's 100 days are over, after a lot of this tariff talk is a little bit more solidified. But so far, most of these corporations are calling for a much more muted 2025. Another article in regards to Ford was a very interesting one where the CEO calls for comprehensive tariff analysis. And it's a very good point that he is making. So essentially what he's talking about in this article is, okay, we're taxing Mexico and Canada 25%, China another 10%. That's all well and good. But what about countries like Japan and Korea? Because for the American auto industry, those are much bigger competitors than Mexico, Canada, or China. Obviously, China is trying to make an inroad into the U.S. market, specifically with their EVs, but currently that hasn't happened yet. At the same time, there is no competition for automotives between Canada and the United States or Mexico and the United States. Quite the opposite. A lot of times there are factories down in Mexico that are shipping up into the United States, being manufactured by American automakers. So those tariffs are going to be hurting U.S. automakers specifically because they're not actually attacking the companies that U.S. automakers can compete with, seemingly Toyota, Honda, Nissan, and obviously Korea is Hyundai and Genesis. So that's what he is calling for. Again, I'm not a tariff guy, but I think there's a lot of logic to it. If you're going to be doing tariffs, you might as well do it across the board. And the U.S. automakers are in the United States, automakers are the biggest manufacturers there are. There is no other manufacturing sector in the United States as large as automotive. So if you're going to be doing domestic manufacturing, you almost have to target Japan and Korea in order to bolster American economy. And this is why tariffs are a bit of a slippery slope and why they cause so much instability in markets. Next story I'm going to talk about is rather interesting. So this one is from Yahoo Finance. The video actually doesn't relate to the article, so I don't think it's worth watching the video. The video actually talks about the U.S. Sovereign Wealth Fund that Trump is signing into law, more or less. We talked about that a couple of days ago. I shared my opinion on that. What this article is actually talking about is in regards to Treasury Secretary Scott Bessent and the Trump administration trying to lower the 10-year Treasury yield. Now, this is interesting. This is truly interesting because, as we've talked about on this channel, rate cuts don't necessarily lead to better consumer rates because for most people, mortgages, car loans are based off of a 10-year Treasury, not necessarily the prime rate. Obviously, the prime rate is a factor, but the 10-year Treasury is usually the bigger outweighing factor. And since the Fed has been doing continued rates, the 10-year Treasury has actually increased in yield. In other words, making borrowing costs more expensive. So interest rates for things like mortgages and cars have gone up despite the fact that the prime rate is down 1%. So it's very interesting that the Trump administration and the Treasury Secretary are trying to target the 10-year Treasury yield specifically. It seems their strategy isn't so much to deal with the Federal Reserve. They're pretty much cutting them out of the picture. They're trying to attack the 10-year Treasury on its face. That's very, very interesting. And it's a very smart strategy. Now, at the same time, I have no idea how you're supposed to do that. Now, they outline a picture for it, but the 10-year Treasury, what you're talking about is essentially public sentiment for long-term growth in the United States. This is more psychology than economics. And obviously, all economics have some psychology at play, but this is essentially public sentiment that you're trying to move. Now, they do outline a strategy. They're calling it, Bassett has called it the 3-3-3 strategy, referring to getting the fiscal deficit down to 3% of gross domestic product. It's currently at 6, and then boosting oil production by 3 million barrels a day and sustaining economic growth at 3% for the year. So it's very interesting because they're saying with this combination of 3-3-3, they're going to increase public optimism and economic outlook for the future. And as such, the 10-year Treasury will just start to drop on its own. If all that happens, yeah, that's a very good factor. That could happen. I'm not as optimistic that it can. The biggest problem with deficit spending is a lot of it is already appropriated, and it's not something that can be changed. It's already been set, and a lot of this stuff that's happening with Doge is just trying to get in at the edges of cutting cost. So your biggest costs, Social Security, Medicare, entitlement spending, those are one of the primary drivers of the deficit. And so bringing the deficit down in half, especially post-COVID, after so many new programs were created, is going to be difficult. You're talking about 50% decrease. So I don't think that's going to happen. Boosting of oil production by 3 million barrels is one of those question marks because it could end up happening towards the latter half of the Trump administration as he's cutting regulations, opening up new licenses and leases. But obviously, when you're pumping oil, this is stuff that has to take time to scale. So this could be another year or two before we're actually seeing oil productions increase by that much per day. Lastly, economic growth at 3%. This is probably going to be the most challenging. So despite everything last year, the economy, as we reported a couple of days ago, grew by 2.4%. That's not bad. That's considered standard for a developed country, but it's still a long ways away from 3%. 3% is an ambitious goal. At the same time, there are these economic headwinds that we've been talking about, and all these companies are seeing a more muted 2025, and tariffs are getting thrown in there that could be the wrench in the cogs of this machine. So that 3% is going to be very difficult to hit. I know Trump is banking on extending tax cuts and on massive deregulation, but I don't think that's going to be enough to hit that 3%. We'll wait and see. I'm cautiously optimistic. I mean, obviously, who doesn't want that? Who doesn't want 3% GDP growth? Who doesn't want better 10-year Treasury yields? That means better borrowing costs for consumers and not so much major businesses, as I've talked about on this channel. I just think this is overly optimistic. I just don't think it's going to happen. That's pretty much it. So those are the stories of the day. I hope you guys have a productive Thursday, and I'll see you guys tomorrow evening. Bye.